The question of who owns the company itself is very challenging because the conventional model is the shareholders own the company. But it isn't really ownership in the sense you own your apartment. You can't come in and just change the furniture because you want to. And thinking of it as if it were that is probably a bad way to think about how to run a corporation. Do you really want your shareholders every year to be able to come in and change their furniture? So in some ways they own a derivative security that trades where the value creation and loss is all dependent on stock market trading. What you could argue, and a lot of free market economists might argue, the market is the regulator and the discipliner. If a corporation performs badly, the market will devalue the stock, people will sell, managers aren't going to make money if their stock's in the tank. The incentives are all toward high stock prices, and high stock prices are a function of performance. And so the incentives actually, the market is enough discipline. Now there are many people who would not accept that, or who worry about corporations and boards run amok, imperial CEOs, and that's challenging. So I think if you added to the market, the other discipline being a election every 2 or 3 years. So if things go really awry, or perhaps even a right for a certain number of shareholders to demand an election anytime, but a really high percentage. You know, if 30% of the shareholders are fed up and want an election, you just have to have it. It's like a recall.